Hello and welcome back. Imagine you've been saving for retirement for decades, building a substantial IRA or 401k balance. Now you hear a financial advisor on the radio warn you that it's all for nothing because there's a tax time bomb set to explode the moment you retire, potentially taking almost all of your hard-earned savings. That's a myth, and it's time to debunk it. I'm Mike Palmer, certified financial planner and founder of Arc Royal Wealth Management. And in this video, we're going to look at the numbers and show you why that tax time bomb is an imaginary monster. First, let's break down why this myth persists. The concern is that traditional IRA and 401k contributions are made in pre-tax dollars. That means that you don't pay tax on that money when you put it into your account. You get taxed on it when you take it out. People fear that these withdrawals will push them into higher tax brackets, leading to a huge tax burden. But here's the reality. Your tax bracket in retirement is usually lower than during your peak earning years. Think about it. In retirement, your income sources are generally Social Security, perhaps a pension, dividends and interest, and your 401k or IRA withdrawals. And those withdrawals can be managed strategically. Imagine your IRA isn't a time bomb, but rather a water cooler. When you're working, you're filling the cooler without paying for the water. When you retire, you'll drink it. Do you chug the whole cooler at once? Of course not. You drink from it as needed, and you're only paying for each glass as you take it. You control the flow. Your IRAs are the same. You control how much you withdraw and therefore how much tax you pay each year. Now let's get into some real numbers. Let's look at a case study that illustrates how a typical couple might fare with a $2 million IRA balance. Meet John and Mary Boomer, both age 67, and they're retiring today. They have traditional IRAs totaling $2 million. Their combined Social Security is $75,000 a year, and they need $120,000 to live on after tax. We're using 2025 tax rates, and we'll assume that they're taking the standard deduction for a married couple both over 65. As you can see, our planning software shows all the details: their standard deduction, their taxable Social Security, their taxable income, and their total federal tax liability, which is just over $22,000. The important thing is their effective tax rate. This is essentially the average tax rate on all your income. For the boomers, their effective federal tax rate's 15%. Does that sound like a tax time bomb to you? I hope not, because it's a very manageable tax burden for a couple in their mid-60s. Now this example doesn't account for potential state taxes, which vary, but the principle remains the same. For a majority of people, the idea of a tax time bomb is a myth, like Bigfoot or the Loch Ness Monster. If you're in or near retirement and have questions about creating a tax-efficient retirement distribution strategy, we offer complimentary consultations. Just click on Book a Call with Mike in the notes below to learn how we can help. What about when required minimum distributions or RMDs kick in? Isn't that when the tax bomb explodes? Current tax laws will require John and Mary to take their first RMD when they turn 73 in 2031. As you can see, we project their IRA balances to be about $2.4 million. That's with a reasonable 6% return. Their RMDs based on that value would be just over $90,000, and their projected effective tax rate would again be about 15%. Now it's impossible to know with certainty what the account values, tax brackets, and tax rates will be in 9 years when the boomers start RMDs. But it's hard to envision a scenario where they'll face any sort of tax time bomb. Here are the key takeaways about taxation of IRA accounts in retirement. Number one, you control the flow. You decide how much to withdraw from your IRA each year, giving you control over your taxable income. Number two, most people are in lower tax brackets in retirement during their working years. Number three, seniors enjoy increased standard deductions, further reducing taxable income. Remember, with proper planning, you can manage your withdrawals to stay in desired tax brackets and minimize your tax liability. The bottom line is most advisors that promote a tax time bomb are trying to create fear. Fear that'll motivate you to buy whatever product they're selling. The reality is, saving in tax-deferred accounts is an incredibly powerful tool for building wealth. At Ark Royal, we believe the best way to achieve a secure retirement is to focus on saving, invest intelligently, and work with an experienced, fee-only certified financial planner that can create a tax-smart, efficient withdrawal strategy for you. If you found this video helpful, please give us a thumbs up and subscribe for more retirement insights. And let me know in the comments if you have any questions. Thanks for watching, and I'll see you next time. If you'd like to learn more about the benefits of working with a truly independent and objective fee-only financial advisor, we welcome the opportunity to talk with you.